If any of you have gone to the bank lately and tried to borrow money as a contractor, I won't ask for a show of hands. It's tough. A lot of contractors that have good banking relationships, God bless them, and I hope they can keep them. But the banks are very tough right now, and that's another thing that sureties are going to be looking at too. Is what is your relationship with your bank? Do you have a line of credit available to you? If you do, what's it secured by? What's the amount? All that sort of thing. Those were, a couple of 3 years ago, that was just a given. Everybody had a line of credit because nobody really needed it for anything. Now they need it, and as you all know the story, if you go to a bank, they'll be more than happy to loan money to people who don't need it. But, if you do need it, not so much. Another thing that sureties are going to really be looking for is, they want to be able to have a discussion with you as to what your contingency plans are in terms of revenue and growth. What do you think you're going to do? What if you don't get there? What does that mean to your operation? Does that mean that you're selling equipment? Does that mean that you're reducing, your staff? What does that mean? And you really need to have a plan in mind as to how that's going to affect your operation. On this first page, this last item I thought was kind of an interesting. I picked this out of an industry publication that I ran into. Bad times chase away surety riders. We're heading into some pretty bad times from the surety business. Only 4 of the top 15 riders from '94 to the day are the same, and all of the rest of those have either gone out of business or they've all consolidated up into other sureties. The largest 5 sureties account for 55% of all the premium written in this country. So there's a real kind of amalgamation into the largest sureties. What effect that has on a lot of the contractors in this room is that it reduces a lot of the smaller sureties out of the market because they just can't compete. That's a trend that probably is going to get worse, over the course of the next few years. Because surety is a very capital-intensive business. In the insurance industry, surety is treated as a catastrophic line of business, like earthquake. Go 20 years, you have great results, bam, you have a bad year, everything you made in 20 years goes out the window. So if it looks like it's going to take more capital than it's going to be able to generate from an insurance company standpoint, they're going to be pulling back on the surety. I will also tell you, surety is a real chicken little business, and I just got the looks of on everybody's face, and they're like, oh my God, the sky's falling. The guy I used to work for, he used to hate it when I called it a chicken little business because we run around, we wring our hands, oh my God, ain't it awful? It is, but it's also a time of great opportunity too. Because right now there has never been a time, at least in my experience, that I have seen so much effort being put into moving business into the hands of small contractors. And really for the life of the surety business and for the life of construction, that really it's just absolutely critical because big contractors don't have them. Big contractors grow from small contractors. And if you start moving a lot of business into small contractors' hands, a number of those will grow into good-sized accounts and some of them into really large accounts. So it's a terrific opportunity time, for some of us in the surety business and and many of your contractors. There are a lot of hurdles, probably more hurdles today to get over than I've ever seen, and a lot of that is in the contract delivery system. I was talking about a lot of the DVs and all the designations, and you take what Caltrans has, and then you multiply that out by a factor of 10 with the federal government and state, and I mean the hurdles seem to be almost insurmountable. The only way out of them is just over one at a time, because that's where the opportunity ends up being, and we have to be in tune with that as well. Marsh and I were talking a little bit before. I used to have an account that was a disabled American veteran, and legitimately so. I mean, the guy was He did it as a Marine colonel. He did a couple of tours in Iraq. The disability was a hearing loss because he was in an artillery brigade. Just shelled the hell out of stuff. Where he was successful wasn't necessarily going in and low bidding all the DAV work. He would go in and bid it. But where he was really successful was protesting the other guys who were bidding it because they didn't know what the hell they were doing. You know, and he'd be fifth, sixth bidder, and he'd get the job every time. You know, and it was great. So my only point to that story is that, you know, even though a lot of this stuff just seems like, you know, there's just too much, you know, you just kind of have to get to it because there is, you know, reward at the end. You know, we were talking a little bit earlier today. I put a note in here about owner's contract term, owner's contract and bond terms, that sort of thing. You know, we talked a little bit earlier about, you know, some of the insurance requirements. You know, everybody's trying to push risk out as far as they can, and the generals are trying to push it down on, you know, the subcontractors. And that's just something that you really have to be aware of as well. What is the risk that you're assuming, you know, on these contracts? And you just have to have some kind of a breakaway point where you're going to say, you know, that's just too much risk. You know, I'm not going to pay for $5 million worth of liability insurance on a $50,000 job. Can't do it. Won't do it. Move on to the next thing. So, you know, we all just have to work smart. Kind of the lifeblood of the surety industry, because it is a credit business, it is really the way that you end up being presented, you know, from a financial standpoint. You know, sureties look to have, you know, your financial statements prepared by a CPA. They need to be prepared generally on a percentage of completion basis. Your bank line needs to be established. Current personal financial statements need to be a part of the package, and you really need to be able to demonstrate how well you're managing debt. Those are kind of four key points that I put in there that I think are just critical, you know, in this market. When the way that the process works, surety-wise, and forgive me, I know some of you are already into this and have done it, but you know, the broker accumulates the information, presents it, you know, to a surety, and then, you know, the surety underwriter makes the decision of what and how much they will bond for, you know, for a given account. So the better the presentation in terms of having financial information that is easy to understand, that is within the norms of the industry, that is timely and correct, the better your chances are of getting bonding and really maximizing, you know, what you have available to your surety lines. You know, if the surety has to go back and haggle with, well, we don't really understand your financial statement, you know, what about this, what about that, it will impact, you know, your ability. So it's real important to have that, you know, available too. And then just my final point that I put in here, and, you know, and I'm shamelessly self-promoting here, but, you know, whatever you do, just work with a professional surety agent, you know, that really, you know, has the market know-how and market intelligence that can help you with some of this risk management and risk mitigation that you might see in some contracts. In my prior life, you know, with one of the major sureties, we had contracts that they would literally scare you to death that anybody would ever sign. You know, in terms of what the general contractors were doing to push liability onto the subcontractors' backs. And I will never forget, I had a conversation with a guy he was doing at one of the big hotels in Las Vegas. He was a tile contractor. For him, it was a really big job. It was $1 million job. And this contract was so onerous that there was no way in the world that this guy was ever going to make a dime out of this thing. And we tried to convince him of that. And he just, well, you know, I know so-and-so, and, you know, we shook on it, and there isn't going to be a problem. Shaking on it isn't going to be a solution to the problem. You know, it just isn't. So really be careful with, you know, with what you sign and what you get yourself into, because it's a legal business, and you know, the whole basis of surety is indemnity. You know, if the bonding company ever has to pay out on your behalf, they will come after you for compensation. It's It's not like insurance where just your auto rates go up.